Today's presentation is grounded in the National Bank of Rwanda's core mandate to first maintain price stability and second to promote a sound and inclusive financial sector. These are critical foundations for a resilient economy and for a trusted financial system. One might ask, why do we still need a monetary policy and financial statement when we have real-time economic and financial data? Well, this September, MPFSS presents economic and financial sector developments for the first half of 2025. And it's not only done as statutory requirement, but as an essential tool for transparent and responsive policy making. Indeed, the central bank issues monetary policy and financial stability statements twice a year to communicate developments in the global and domestic economy, as well as the rationale for monetary policy decisions. It also highlights the performance of the financial sector, looks at stability indicators, as well as risks within the financial system, coupled with the central bank's measures to address them. The MPFSS, therefore, supports macroeconomic stability, guiding market expectations, and reinforcing confidence in the economy and financial sector. Having set the scene, in particular for our guests who are attending the MPFSS for the first time, let me start by presenting the key developments of the global economy and Rwanda's economy in the first 6 months of this year. First, global GDP trends. Global GDP growth is projected to slow down to 3% in 2025 from a GDP growth of 3.3% that we had last year. And according to the IMF's World Economic Outlook, global GDP should slightly recover in 2026 with a growth of 3.1%. And when we break this down by region, we see that advanced economies are expected to grow more moderately to 1.5% from 1.8% in 2024, before a slight recovery in 2026. As for Sub-Saharan Africa, the GDP growth is projected to stabilize at 4% in 2025, with expectations of improved performance to 4.3% GDP growth in 2026, reflecting the region's economic resilience post-COVID and all the external shocks that we have observed in the last 5 years. In the context of a slowing global economy and shifting global trade policies, global inflation is projected to continue easing at 4.2% in 2025, compared to the 5.6% global inflation that we had in 2024. Inflation is expected to further ease to 3.6% in 2026, reflecting lower energy and food prices and improved supply chain conditions. However, in Sub-Saharan Africa, inflation is projected to remain in double digits, but taking a decelerating path from the 18.3% inflation rate we had last year to 13.3% in 2025, reflecting pressures that we still feel from currency depreciations in Sub-Saharan Africa, as well as high food prices which still persist in some economies. This global easing of global inflation is on the back of commodity prices which are on a downward trend. The energy index, which incorporates prices of crude oil and natural gas, is projected to decline by 17.4% in 2025 and further by 5.6% in 2026. And this reflects weaker demand for energy products while there's ample supply. And for instance, if we look at crude oil prices, they are expected to decrease by 20.7% in 2025 and further by 6.3% in 2026. And if we take the period from January to June, crude oil prices decreased by an average of 14.6%, from $82 per barrel that we had in the same period in 2024 to around $70 a barrel by the end of June. And this is a reversal of the 5.4 increase that we had recorded for crude oil prices in 2024. The non-energy index is also projected to decline, with global food prices expected to decline by 7% this year and slightly decreasing by 0.8% in 2026, easing import cost pressures, especially for Rwanda's economy. What we have observed, however, is that prices of export commodities such as coffee as well as minerals remain elevated, which supports Rwanda's exports earnings, as we will see in a moment. And the increase in metal and mineral prices is due to the high demand for mainly the electronics and tech companies globally. After the assessment of the global economy, the following section focuses on the domestic market. Rwanda's economy in the first half of 2025 remained robust, with real GDP growth at 7.2% in the first 6 months of the year, as announced yesterday by the National Institute of Statistics. And indeed, with the rebasing of the GDP numbers to 2024 constant prices, GDP grew in the first quarter by 6.5% and then by 7.8% in the second quarter of 2025. The strong GDP growth that we see was supported by first services sector, which grew by 9.4%, then the industry sector growing by 8.8%, and modest agricultural recovery for the 6 months at a growth of 1.7%. But we need to point out that in the second quarter of 2025, we've seen agricultural growth reaching 8%. The growth of the services sector is mainly driven by strong growth in trade and services by 14%, while the industry sector growth is driven by construction, which grew by 12.5% on the back of major infrastructure projects. From the domestic economic growth data, we move on now to international trade. And Rwanda's international trade performance was very strong in the first 6 months of 2025. As we can see, exports increased by 6.2% in the first 6 months, driven by mainly coffee exports, minerals, and non-traditional exports. On the other hand, imports grew, but at a slower pace, at 4.5%, and this resulted in a trade deficit recording a modest increase of 3.6%. But we can see that in the second quarter of 2025, meaning from April to June, we actually had a narrowing trade deficit, which is a good development on the back of the very high growth of merchandise exports in the second quarter, growing at 15.5%. And these positive developments of the external sector explain why our currency has stabilized, with the foreign exchange pressures easing. The Rwandan franc's depreciation against the US dollar at the end of June stood at 2.9%, which compares to a higher depreciation rate that we had in the same period in 2024, where the depreciation at that time was at 3.7%. And one may recall that 2023 and 2024 were years with high levels of depreciations reaching 18% and 9% respectively. And this improvement in the foreign exchange market were supported by an improvement of the trade deficit, especially in the second quarter of 2025, as we just seen in the last slide, broader weakening of the US dollar in global markets, especially in the second quarter of 2025, and then domestic foreign exchange market reforms that were conducted in the first half of the year. The next session looks at developments in the interbank, deposit, and credit markets. In the first half of 2025, we had reduced the central bank rate from 7%, which we had as of June 2024 to 6.5%. And all the rates declined, starting with the interbank rate, which reduced from 8.21% to 6.51%. The deposit rate also decreased from 10.2% to 9.6%. And the lending rate also declined from 16.3% to 15.9%. Although last month the Monetary Policy Committee decided to slightly increase the central bank rate to 6.75%, we expect the trend observed on the interbank and credit markets to remain in the medium term. And this monetary policy decision taken last month was driven by a revision of our inflation forecasts. As we will see in the development of the inflation data, in the last 3 years, our inflation had reached record levels, especially in 2022, but started easing, as you see on the slide, starting from the first quarter of 2024 and coming back towards our target band of 2 to 8%. In the first half of 2025, headline inflation stabilized at 6.7% from the 4.6% that we had in the first half of 2024. And this slight increase of headline inflation was due to increased core and fresh food inflation, while energy inflation declined. And the increase that we observed in core inflation was primarily driven by significant increments in food inflation, as well as core hotels and restaurant prices. Fresh food inflation also rose significantly in the first half of this year, primarily driven by higher vegetable prices, largely reflecting the moderate performance of agricultural season during season A, but also increase of fruit prices as limited supply during the growing period pushed prices higher. However, energy inflation, as you see on the slide, eased following a decline in liquid fuel. Liquid fuel incorporates petroleum products, and this easing of energy inflation was mainly influenced by lower international prices in the first 6 months of the year. But on the solid fuel, which is composed of charcoal and firewood, we also saw an easing inflation supported by favorable weather conditions that ensured stable supply of both charcoal and firewood on the local market. In August 2025, headline inflation stood at 7.1%, which is still below the upper bound of our inflation target. Looking ahead, our assessment points to an inflation that will average 7.1% this year, and then easing to 5.6% in 2026. However, there are risks to this outlook, mainly linked to adverse weather conditions, which could affect agricultural production. In particular, we see that climate change continues to impact our traditional agricultural season and rainfall patterns, and this is a risk that we monitor closely, working with the Ministry of Agriculture, the National Institute of Statistics, but also Meteo Rwanda, Rwanda's meteorological agency. Other risks that we see to these projections are the global geopolitical tensions, as well as international trade policies uncertainties that may impact and influence domestic economic conditions. To navigate these trends, the central bank will continue to monitor these developments, and we stand ready to take appropriate measures to build the necessary resilience for our economy against any external shock. Next, I will move on to the financial sector stability and performance. First, we can see that our financial sector continues to expand. As of June 2025, total assets of our financial sector had increased by 23% compared to the same period in 2024, reaching 14.3 trillion Rwandan francs. And when we look at the financial assets to GDP, The ratio also rose to 66% from the 65% that we had in June 2024, indicating increased financial deepening, and this growth was driven primarily by significant increases in key assets components, including contributions from the pension sector and return earnings by our financial sector in all subsectors, being banks, microfinance, insurance, and the pension sector. In addition, credit to GDP has also increased slightly, reaching 27% in June 2025, compared to 26% that we had in 2024. When we look at the credit market developments, lending continued to increase, with also an improvement in quality of loans across banks and microfinance. Outstanding loans in both sectors increased by 15%, another double-digit increase, with the outstanding loans now reaching 5.6 trillion Rwandan francs. And when we look at the top 10 finance sectors, construction, in line with the growth in construction that we've seen in the first 6 months of the year, are in the top finance sector, followed by trade, manufacturing, and then household, which include individual loans, transport sector, accommodation and food services. This includes restaurants, real estate activities, electricity and energy sector, then education and agriculture. And here we have to emphasize on the fact that being the microfinance sector, but also the non-deposit taking lending companies, has contributed significantly to the financing of agriculture in the last 6 months. When we look at non-performing loans, they are below the maximum threshold of 5%, being for banks or microfinance. The NPL ratio for banks stood at 2.6% in the first 6 months of the year, while for microfinance institution, NPL ratio was at 3.4%. For the financial sector stability indicators, we can see that our financial sector remains strongly capitalized, with the capital adequacy ratio of banks standing at 21.6%, which is above the 15% required minimum. For microfinance institutions, it's the same trend. It also has adequate capital buffers, with 34% of capital adequacy ratio, which is way above the 15% required. And the insurance sector also had a solvency ratio at 215%, above the minimum required of 100%. And this gives us confidence that our financial sector has enough capital to absorb potential shocks. On the liquidity side, we also observed that our financial sector is sufficiently liquid to meet any short-term needs. The bank's liquidity coverage ratio stood at 289%, while the liquidity coverage ratio for microfinance institutions was at 73.8%, above their minimum required liquidity coverage ratio, while for insurance is the same trend, also with a liquidity ratio at 109%. Our financial sector continues to be profitable, with the profitability sustaining not only expansions, but also the growth of assets with an increase in retained earnings. The return on equity for the banking sector stood at 18.9%. For the microfinance, the return on equity was also in double digits at 14.8%, and the insurance sector had the highest return on equity at 19.2%. Looking at our pension fund, the total assets of the pension sector also increased by 26%, with total assets at the end of June 2025 reaching 2.3 trillion Rwandan francs. When we look at our public pension contributions, there was a significant increase driven mainly by government's reforms on the statutory contributions, but also this contributed to increase in benefits that are dispersed to people in retirement. And the Ejoheza long-term savings scheme, which covers people in the informal sector, there was also a significant increase in contribution by 55%, reaching total contribution of 11 billion at the end of June. And this was driven mainly by extensive outreach programs to mobilize people to save through Ejoheza. On the payment systems, we continue to see that innovation in digital payment systems have supported and continue to support the cashless economy agenda of government, with electronic payments valued now at 302% of GDP, while electronic retail payments continue to increase, reaching 33.5 trillion from January to June 25, which is higher than the 21.4 trillion that we had as value of retail payments in the same period in 2024. In addition, the Rwanda Integrated Payments and Processing System, RIPS, was upgraded in the first half of the year, offering real-time, round-the-clock transaction capabilities and also complying with the new global payment system messaging standards, ISO 20022. And this is an important step in meeting global payments standards, but also boosting efficiency, enhancing Rwanda's financial market infrastructure to support not only domestic transactions, but also cross-border transactions. As you can see, the improved system availability led to an increase in higher volumes of transactions in June 2024, reaching 2.7 million, whereas in the transaction value, we are above, for the first time, 10 trillion Rwandan francs in the first 6 months of the month. Our outlook for the financial sector, we expect the sector to remain stable and resilient, supported by the strong capital position, ample liquidity buffers, but also continued operational efficiency. However, we see that we need to remain vigilant on emerging risks that we observe, linked to one, uncertainties surrounding the global economic performance, which could influence our own economy's performance, the loan concentration risk, as well as fraud and operational risk, mainly due to increased digitalization of our financial system. And the central bank, as financial supervisors, continue to enforce prudent risk management practices within the financial system, as well as implement timely and adequate policy measures to preserve the stability of the financial sector. As a recap for the key economic and financial sector developments in the first half of 2025, we observe that one, global economic growth is projected to remain subdued. However, Rwanda's economy continues to perform well. Third, the foreign exchange market has stabilized, with the Rwandan franc destabilization easing due to recent external trade performance, but also market reforms in the foreign exchange market. And fourth, inflation in Rwanda is projected to remain within our target band of 2 to 8%. For the financial sector, we've seen that Rwanda's financial sector demonstrated resilience and sustained growth in line with the growth of the domestic economy. Lending continued to expand across all sectors of the economy, supporting private sector activity and investments. And financial institutions overall remained sound and stable, while digital transactions are expanding, supported by innovative and efficient systems. Hence, in spite of global headwinds, the central bank remains confident about Rwanda's macroeconomic stability, sustained growth, and the soundness of our financial system to support the financial resilience of households and businesses. So this marks the end of our monetary policy and financial stability statement for the first half of 2025, and we are ready to take your questions and engage in meaningful conversations. I thank you all for your kind attention.